In this video we want to talk about risk and how to manage risk. Risk management is the identification of potential risks to a project and organizational plans. So risk management is trying to see what sorts of risk can impinge upon the organization, what sort of risks can damage the organization or damage a particular aspect of the organization. For example, damage a product, damage the production system, damage the marketing image of the business. So damage can be inflicted on a business in various ways, and we'll go through some of them here in this session. But it's essential for management to have some sort of contingency planning in place to deal with risks and to deal with the outcomes of risks. Should a risk arise and manifest itself and the business faces some sort of catastrophic danger, then it's imperative that the management have some sort of contingency to deal with that. So risk management is very important. It's important to identify and assess risks and resolve them before they cause harm to the organization. That's the point. It's important for the management to try to identify all the risks, or as many as possible, that can damage the organization, damage the company, and then try to take steps to minimize their impact should they arise, or even obviate the risk completely, get rid of the risks completely, get rid of the possibility of it happening, or if it does happen, have some sort of plan in place to deal with it. Risk management includes monitoring, coordinating activities, application of resources to reduce the possibility of risks occurring. So it's important to try to imagine what risks an organization faces. Just imagine the risks, make a note of these, and have meetings with colleagues and try to brainstorm the types of risks that the organization faces, and then put in place some sort of plan to deal with those risks. So should they arise, the organization is in a position to deal with them logically, coolly and calmly, and to remove the possibility of hurt or damage to the organization. There are different types of risks and uncertainty that organizations face. I say risks and uncertainty. These are two different concepts. Risks are ones which have a probability of happening, and the probability, generally speaking, can be calculated. Insurance companies constantly try to work out the probability of events happening so that they can levy appropriate charges to customers. But uncertainty is a situation where the company has no idea about the future, has no idea about what's likely to happen. It just simply knows that something perhaps bad could happen in the future, something unanticipated, but it needs to have a plan, perhaps emergency funds in place to deal with that eventuality should it arise. So risks, by and large, the company can calculate. What's the probability of something happening? Uncertainty, they simply don't know. They don't know if it could arise tomorrow or never arise. It's just something that may or may not happen. So the different types of risk. Well, financial, all sorts of financial issues could confront the business. A fall in revenue, customers turn against the product, reduced sales because there's a recession in the economy, consumers have less spending power, interest rates may rise, or there are all sorts of financial issues that confront the business. Competitors are not passive, by and large. Competitors are out to try to gain competitive advantage. Competitors want to win, the same as the company wants to win. the competitors to the company want to win as well. They want to have a bigger market share, to be the market leader, to dominate the market. So they're constantly innovating, changing, experimenting, introducing new processes, new products. So that's a risk to the company. Project failure, for example, production. The production system could fail. The machinery could fail, or something associated with the production system could fail, leaving the company without an output, and frustrated customers, and a bad image for the business. The product life cycle. The product could be in existence for many years and now be seen by customers as old-fashioned and out of date. There may be design implications as well. Perhaps the product has fallen out of fashion. It hasn't kept up with the required changes that the customers want to see in products. There could be legal changes that the company hadn't seen before. Perhaps changes in pollution legislation which will affect the business. These couldn't have been seen some years earlier, but the business needs to cope with these changes. It could be changes in employment law, changes in consumer protection. There are many changes to legislation which can affect businesses, and the businesses must have some way of dealing with those changes and meeting the requirements of the law. Employees' attitudes to work may change. Some occupations may not be seen as attractive. For example, working in dark, noisy environments with a lot of heavy engineering, that may not be seen as attractive. So attitudes to work may change. There may be workplace accidents because perhaps as the technology within the workplace changes, employees are not particularly skilled at the new processes required, leading to accidents. So constant programs of training and retraining and processes to deal with proper application to the new tasks, proper application of the workforce to the new tasks, so the workforce are capable of dealing with the new requirements of the new technologies and to avoid accidents as a consequence. And of course, there's the ever-present possibility of natural disasters, flooding, for example, or storm damage. So the company needs to have some sort of contingency in place should these arise. There are also, of course, external issues, political, economic and technical, which are constantly changing. The political environment within which the company operates. The company wants a stable political environment. It wants one which it knows it can plan forward, knowing that the political system is not going to experience major upheaval, and there's going to be very dramatic changes in the way governments see business. The economic environment should be quite stable as well. When markets are very turbulent, companies find it difficult to plan forward. And in periods of very rapid technological change, it's very difficult for companies to plan because they're not quite sure if the technology has settled yet, or if the technology is going to further change and there'll be new innovations. And therefore, the companies who come in last will have the best technology because they have reaped the benefits of waiting. But if they wait too long, of course, they may lose their place in the market completely. So there are all sorts of risks that confront businesses. Risks can fall into the following categories: preventable risk, strategy risk, or if you like, strategic risk, and external risk. Now let's have a few words about these. We'll start with preventable risks. Internal risks that can be identified before the start of the project. So looking at what are the risks when a project is being set up. What are the risks? Try to itemize all the various risks. Try to make a note of these and try to design plans which can cope with the eventualities arising from those risks if they do occur. So looking at what risks, make a list of the risks and then try to design strategies or try to design plans which can be implemented to ameliorate the risks, reduce the bad effects of the risks when they arise. Now, preventable risks can be controlled. They can be monitored and resolved from within the organization. They're preventable. So look at the risks that could arise and deal with them. And many risks can be changed in the sense that made less, reduced, or they can be prevented completely. So, for example, look at preventable risks in terms of production and employee welfare. Perhaps having proper guards on machines and proper training, proper processes that prevent injury to the employee. Now, these risks, the risks of injury in these cases, are preventable by having the proper equipment, the proper guards on the machines, proper training for the employees and so on. The risks are preventable. So, examples of preventable risks could include unauthorized, illegal, unethical actions taken by employees and employers. These are preventable. If the company or the employees are acting illegally, that is preventable. Just get them to stop acting illegally. Make sure that the processes within the organization are ethical. Make sure that they are proper, so there's no damage to reputation or damage to the organization. And not only damage to the organization, there's no damage to innocent bystanders or customers who were affected by making shoddy work and selling it off and posing a danger perhaps to customers. So these are preventable risks, ones which can be got rid of. Risks can also involve breakdowns in the operational process. So it's possible that preventable risks could mean the process breaks down because perhaps the machinery is not being maintained. That's preventable. So the company does not hurt itself by running the risk of perhaps machinery breakdown because the machinery has not been properly maintained. They're all preventable. So companies that operate illegally, perhaps employing untrained workers in dangerous occupations within the business, that's preventable. Just stop doing it. Give the employees proper training, give them proper equipment, give them proper protection. So there is no risk to life or limb and no possibility of legal action as a consequence of the behaviour of the business. So all preventable. Now, strategy or strategic risk. A strategic risk is calculated risk based on predictions and forecasts. They're based on an organization's research and development. So strategic risk is looking at predictions and forecasts. It's what's likely to happen. It's the company thinking if they continue on this course of action, then there is going to be some issue. The machines will break down, or the workers will not be able to cope, or there's going to be some sort of damage to the organisation. It's strategic, it's calculated. And I suppose in this context, instead of saying strategic risk, we should have said calculated risk. It's much the same thing. The aim of strategic risks is the hope of high returns. For example, a credit risk from a bank to pursue a new venture. So strategic risks normally are undertaken by businesses in the hope that they will generate future revenue streams. For example, a company may think about buying a new machine because it'll speed up the throughput of the work through the organisation, enable the organisation to sell more in the market and so on. But to do this, it might require a very expensive piece of machinery. So it takes a strategic risk. It goes to the bank and borrows the money to buy the piece of machinery. And perhaps then finds the customers don't want to buy the extra output. Now the business has got a very expensive machine and a bank loan, neither of which is really wanted or could afford. That's strategic risk, and that's when it can go wrong. It's not desirable. It's necessary sometimes for growth and development. And the whole idea of entrepreneurship is taking risks, is trying to imagine what the customers want, trying to vary the product and taking a risk. And if the entrepreneurs are correct, they will make profits. But if they get it wrong, they can damage the company, that could go out of business. So they don't want to take on risk, but sometimes it's necessary to take on the risk because that's the only way the business is going to grow. So the example about going to the bank and buying the machine only to find that the extra output was not required, that was when it goes wrong. But if the entrepreneurs got it right, if the business managers got it right, then buying the machine could lead to extra sales, greater share of the market. They could do better against their competitors, in which case it would have been a big success. So strategic risk is trying to work out what is the right thing to do, trying to calculate what's the right thing to do, trying to estimate what's the right thing to do, and expanding the business or changing the business in light of those considerations. Then there's external risk. External risks are outside of the organization's control, therefore cannot be managed or controlled. External risks are just the environment. They're within the environment. The organization can't do anything about them. These happen. It could be political, economic, and natural disasters. Governments change. The new government comes in with policies which are not kind to business. They want to tax the profits of the business, and that will stop the business from growing and developing, or it may consider that the company should not export to a particular country because there's a dispute with that country. These are risks outside of the business. Business can't do anything about this. This is the government making these decisions. Likewise with the economy in total. Individual companies are too small compared to the whole economy. So the individual companies have to survive in that environment, the economic environment of the country. The economic environment of the country could be one in which there's high rates of inflation or high interest rates, or balance of payments problems, or the exchange rate may be moving in the wrong direction for the company. There's nothing very much the company can do about this. It just has to work with whatever's happening and try to deal with it. And of course, the case of natural disasters should be obvious. There's nothing the company can do about the weather, or about flooding, or about storms, so there's very little the company can do. They can take out insurance and try to cope with these problems by dealing with the implications of the problems. Should a storm arise and the roof is damaged, then it may be able to insure the roof with an insurance company, and that way spread the risk and get some compensation. But by and large, these are external to the business. Organizations must identify the management of these risks. Measures are focused on the impact these actions will have on the organization. So they try to list out the types of risks and try to find some solutions, some ways around the risks should they arise. But by and large, there's very little the company can do. There's actually nothing the company can do about these risks. They simply happen. Now, managing the risk, well, there is a process to the identification, analysis and assessment of risks. For a start, identify the potential risks and try to categorize them. Look, what risks does the company face? Are they preventable? Are they strategic? Are they external? These are the three categories we just looked at. So try to list out what are the risks the company face and try to categorize them on their preventable, strategic or external. And at least now the management know what risks they face and the category of those risks. Look at the risk vulnerability, not vulnerability, sorry. Look at the risk of vulnerability and threat to the organization. Look at what are the threats to the organization. Try to list out the risks and look at the threats. Assess the organization's resources and capabilities to consult, to deal with, to consult, to in a sense to speak to the risks, to understand the nature of the risk, what's likely to happen, look at the resources so that they can address the risks. They can deal with the risks. See what resources the company can have to try and deal with the risks. Consider the possible consequences and impact of the risks. Look at the various risks that the company faces, and if they come to fruition, if they actually happen, if these risks arise, what will be the impact on the business? What will happen? And how can the company deal with that? Try to evaluate solutions to reduce the risks. Insurance, I mentioned earlier, may be a possibility. It's not available in all situations, but in some situations, perhaps against climatic issues and storms and natural disasters, it might be possible to take out insurance. But the company can't really insure against customers not buying its product, or of new products coming onto the market, or of the general economic environment turning down in the country. These are not insurable risks. But try to see what the company can do. What solutions can the company come up with? Maybe having a reserve fund. The company should have reserves to meet short-term problems. Obviously, if they're long-term problems, then the survival of the business may come into question. Try to implement risk reduction and elimination if possible. Try to get rid of the risk if possible. But this can only happen, of course, if the risks are properly identified, properly categorized, if the company has the resources to deal with the risks during the duration of the risk, if it's got the capacity, the overall capacity in terms of the ability of the management and the resources, the financial resources, the technical resources, and almost the goodwill of the workforce who understand what's happened, the types of risks that the business confronts. Now, the importance of risk management. Well, create value for the organization. Certainly if the organization has good risk management plans, then that organization is much more secure than one just drifting along and oblivious to the risks that it confronts. So good risk management means having the reserves, having the capacity, having a workforce who are trained to be flexible and to cope with changes, and so the organization is more prepared, and that creates value for the organization. That organization is in a better position than one that simply drifts along. The risk management should be implemented, and it should be in the strategy of the business, the overall strategic framework of the business, so that it permeates the whole business. It should go right down to operational plans. Line managers should understand risk, that what happens if the machine breaks down? What will the line manager do? How will the work continue if a machine breaks down? So there should be some assessment of risk at the very micro level, but also within the organization at the more macro level, that if there's an issue related to the economic environment in which the business operates, how can the business cope with this? What are its plans? It may want to diversify production, or it may want to open a branch in another country so as to diversify the risk. So if one country is going through a bad patch, perhaps the other country will be able to continue production and help the organization overall. But it should have some sort of strategic plan to deal with risk. It helps management in decision making. Whenever management make decisions, they should factor in the risks. Sometimes management do this by looking at what's the most optimistic outcome they could expect, looking at what is likely to happen, that's a second alternative, and thirdly, looking at the pessimistic outcome, and then trying to decide, are they optimistic, pessimistic, or neither? So when they're making decisions, this should build in some element of risk assessment. And try to overcome the threats before they arise. Try to anticipate what's likely to happen, try to anticipate what is happening, and try to deal with these. And try to deal with them before they become a major problem. The risks can be tailored and adapted to organizational needs. I mentioned earlier that the environment, the economic environment, may have a major impact on businesses. Well, not all the economic environment will have an impact. There might be just some parts. Perhaps the government intends to increase corporation tax. So what other issues can be taken into account by the business? Perhaps it may wish to engage in a program of investment so as to offset the profits of the business. There may be higher rates of depreciation as a consequence of more capital investment, and this may be allowed for tax purposes. So it's a question of the management being clever and trying to work out ways in which it can cope with broader change. So it tries to tailor its activities in a way that sidesteps risks, if possible. Be part of a continuous improvement system. By trying to avoid risks and trying to measure risks and identify risks, it's trying to survive. The organization is trying to survive. It's trying to produce its product. It's trying to maintain the workforce. It's trying to maintain its plans, and it's trying to do this, and in an environment which perhaps is risky. But if it engages in improvements, say cost savings, more efficiencies, better product development, better design, it can sometimes get rid of the risk by strengthening its own position in the marketplace. It's less vulnerable. Customers like the product, they like to identify with the product, they like the company. Because the company is seen as innovative, it has good quality products, it has good reputation, and because of these, perhaps the organization faces less risk. If it had a lower estimation in the marketplace, it may be more vulnerable. The customers are not loyal. The customers don't mind which product they buy, the company's product or one of the competitor products. So that makes it more risky for the organization. But if the organization has developed its reputation through a good reputation, the way it treats its workforce, the way it treats the environment, its emphasis on quality, its reputation, the way it markets itself, its after-sales services, it can get rid of some risks by virtue of behaving in this way. By and large, risk is part and parcel of our everyday lives. We all face risks, and sometimes we don't necessarily take them all into account. Organizations who are trying to survive must try to estimate what risks are out there and the extent of the risk, the likelihood of the risk being serious and damage the organization. When it has identified the risks, it should try to take measures to reduce the risks, if possible. And these are various ways in which the organization may respond to the possibility of quite serious damage arising as the result of risks confronting the organization and making life difficult for the organization should they arise. But that's all we're going to deal with in this session. It is a very important topic. It's one that certainly must be factored in during the whole strategic design of the business and the whole decision-making process. But that's all we're going to deal with now, so let's leave it at that and say thank you for watching.